Taiwan Semiconductor reported earnings today. They actually missed on revenue by $900 million, and the stock is still up almost 6% on the day. In this video, in the next 5 minutes, I'm going to explain why the stock is up even though they missed earnings and tell you about why I own this in my portfolio and what I expect to happen moving forward. I'm not going to waste your time, and I'm going to make this as fast as possible to be respectful of your time. The only thing I ask from you is to like the video if it's helpful and then subscribe to the channel so you get notifications every time I release these high quality, quick videos. We're going for under 5 minutes. Here's my position in Taiwan Semi. It is currently worth $14,640. You can see I own 169 shares at an average share price of $63.63 a share. And right now the share price is at $86.29. So you can see from 63 to 86, we're up quite a bit. My cost basis is $10,759 and is currently worth $14,640. So we're doing great. If you're interested in what stocks I'm buying to know before I buy them and then coverage and deep dives on stocks, I have an email newsletter, austin.substack.com. I send one free email newsletter every week, and then there is a paid option where I tell subscribers my whole portfolio and what I'm buying or selling before I buy. I usually don't sell, so it's mostly just what before I buy. And then I also let subscribers vote on deep dives that I'm going to do to teach you about investing and about the best businesses in the world. We are running the vote for the first deep dive. It's on PoolCore, Snowflake, and SoFi Technologies. I'm not necessarily bullish on all these stocks. They're just the stocks I want to learn about, and you can see Snowflake is winning. I'm running 50% off. That means it costs $10 a month or $9 a month if you're interested in that. If you're not, then let's get to the video. So the stock jumped after mixed Q4, but confirms it will cut 2023 spending. So everybody's wondering, why is the stock up 6% today, even though they missed on revenue and they just barely beat on earnings? Well, it's because they confirmed that they're going to cut 2023 spending, which means they're going to conserve cash flow. They're going to get essentially more profitable and more capital efficient, and that's going to pay off moving forward. They're still going to maintain their leadership, their dominant leadership position, and they're going to create this new foundry in Arizona and still lead the way, and this industry is not going anywhere. So it's just a matter of how people are valuing this company. And the bottom line, this is fast graphs right here. It is, in my opinion, the fastest way to tell if a stock is, trading below where it historically has. You can see stock price 81 at a PE of 13, The average PE ratio since 2002 or 2001 has been 19. That's represented by this blue line. So you can see it is significantly below its average PE ratio of 19. And they're still expected to continue growing earnings moving forward. A little bit of a down year in 23, but then 18% growth in 2024, 12% growth in 2025. And if it gets back up to around its average of 19, you're looking at a total annualized return of 24% for a total return of 90%. Now, I don't expect it to get back up to 19, but even if it just trades up to, it stays at a PE of 13, you're still going to make, 10 to 12% per year. If it trades up to a PE of 15, then you're looking at, 13, 14, maybe 15% per year. But either way, for a company that is as dominant as Taiwan Semi is, expected to continue growing earnings, it's trading undervalued compared to where it historically has. It is historically a market beater. It's since 2002, a $10,000 investment would now be worth over $103,000 for almost 12% compounded annual growth versus about 8% compound annual growth in the S&P 500. And that's what we love to see, a market beating stock. If we jump over to here, this is just another way to see what analysts are expecting in terms of price targets. I pretty much ignore these. These are just a range, right? But it just tells you what Wall Street is thinking. They think the low price target is 72. The average that they have, the base case is 103, which is about a 20% gain. And this is 1 year price targets for December 22nd, 2023. So they think this is where it should be. And then high of 148. I don't expect that at all. A 71% gain. I don't care about a 70. If it happens, great. But then I certainly, probably wouldn't be buying it if it goes up 70% over the next year. Probably wouldn't sell my position though either. We see what analysts are expecting. We see the price targets. I think the stock is undervalued. This is not all you need to know to buy a stock. What I'm explaining is that this stock was undervalued compared to its historical valuation. They pre-announced revenue, so that was already known, And now we're seeing the stock go up after missing earnings, which doesn't make sense to a lot of people. But the reason that that's happening is because they're getting more efficient, they're cutting costs, and all of this bad stuff was already known anyways. A lot of people are scared to invest in the market right now because of all this bad news out there. Well, if you're a long-term investor, in my opinion, that is the best time to just continue building your portfolio. We don't go all in. We don't take ridiculous, crazy bets. We are long-term investors trying to build long-term wealth by owning great companies. If you like this kind of content, like the video, subscribe to the channel, check my email newsletter out, austin.substack.com, or don't, and just come back to the video and keep watching. Let me know in the comments what companies you want me to cover. I am covering the dividend tab real quick. Another thing about Taiwan Semi, they pay a small dividend, only 0.42%. But the 5-year compound annual dividend growth rate is 9.46%. So they've grown that nicely, even though they're still investing in all of these factories and foundries and, innovating and continuing to improve their products and get more innovative and more efficient. The payout ratio is only 5.9%, and free cash flow payout ratio is 10.3%. So pay a nice dividend. Stock's a market beater long term, and it's positioned in a really important industry as a market leader. I think it's undervalued. I'm going to continue holding the stock. What you do is up to you. This is not financial advice. Have a great day. Let me know what other stocks you want me to cover in the comments.